You're 30 years old, staring down what could be the single most expensive bill of your entire life. And no, it's not your mortgage. The average American will pay over $1 million in taxes across their lifetime. And most people don't even flinch because the money never touches their hands. Here's the wild part. The tax code isn't a punishment system, it's actually a menu. And most people just never learned how to order. The government has quietly embedded decades worth of incentives, deferrals, and shelters directly into the law, practically begging you to use them. Think of your income like water flowing through pipes without the right valves. It all drains straight into the IRS's bucket before you ever see it. But at 30, you have something that no 55-year-old can buy back: time. And time is the most powerful tax reduction tool that exists. The first lever every 30-year-old should pull is tax-advantaged accounts, 401s, IRAs, HSAs, but most people treat them like optional upgrades rather than the foundation of the whole strategy. A health savings account alone is the only triple tax-free vehicle in existence, meaning contributions go in pre-tax, grow tax-free, and come out tax-free for medical expenses, yet fewer than 10% of eligible people maximize it. Now here's where the optimism of early financial planning usually crashes into reality. People contribute a little, feel good about it, and then stop thinking strategically when life gets expensive. The mortgage hits, the kids come, the contributions stall, and suddenly your 30-year-old tax plan looks exactly like everyone else's: reactive and regretful. Behavioral economists call this present bias, and it's basically your brain handing the IRS a tip. You discount the future so heavily that saving $500 a month today feels more painful than losing $200,000 in avoidable taxes over 20 years, even though the math is laughably one-sided. History gives us a pretty clear blueprint here. Every major wealth-building cycle post-war, the 1980s bull run, the dot-com recovery, the post-2008 real estate rebound, rewarded people who used legal tax structures aggressively and early, not people who waited until everything felt certain. Real estate investing, in particular, has been one of the most durable tax minimization strategies across every single one of those cycles, because depreciation, cost segregation, and the 1031 exchange are not loopholes, they are features. And yes, we know what you're thinking. That's for rich people or big investors. But that is precisely the misconception that keeps middle-income earners overpaying for decades. A single rental property can generate what's called paper losses through depreciation that offset your ordinary income legally, annually, and without you actually losing a dollar of real cash. The Roth conversion ladder is another strategy that sounds complicated, but is really just patience in a tax costume. You convert pre-tax retirement funds to Roth during low-income years, career transitions, sabbaticals, early retirement gaps, paying a modest tax rate now to permanently eliminate taxes on potentially millions in future growth. What most 30-year-olds also miss is that your tax bracket in retirement is not fixed. It's something you engineer today through the accounts you open, the assets you hold, and the income streams you build. A person with all their savings in a traditional 401k and nothing in Roth or taxable accounts has essentially handed the IRS a blank check to fill in later when rates may be higher. Process beats prediction every single time in tax strategy, just like it does in investing. You don't need to guess future tax rates. You need a diversified tax bucket strategy where you have pre-tax, post-tax, and tax-free accounts working simultaneously so you can pull from the most advantageous source in any given year. The discipline is boring, the results are not. Someone who starts Roth contributions at 30, maximizes their HSA, owns 1 or 2 income-producing properties, and harvests tax losses annually could realistically reduce their lifetime tax burden by $300,000 to $500,000. Not by cheating, but by simply using the system that already exists. At the philosophical level, tax minimization isn't about distrust of government or hoarding wealth. It's about recognizing that every dollar you keep is a dollar you control, and control compounds just like interest does. The people who build real, lasting financial freedom are almost never the ones who earn the most, they're the ones who kept the most. Consistently, without drama. So yes, Be comfortable not knowing exactly what tax rates look like in 2045 or 2055, because the strategy doesn't require certainty, it only requires consistency, the right account structure, and the humility to start before you feel fully ready. Whether rates go up, down, or sideways, the diversified tax approach protects you from every version of that future. And if you're ready to take that first step, whether it's investing in real estate to generate those depreciation benefits, finding a contractor to renovate an income property, or connecting with a lender who understands investment strategy, check out our links in the description below.